Infrastructure examines infrastructure as an important category of alternative investments within the program. Infrastructure investments involve long-lived physical assets that provide essential public services and support economic activity. Examples include transportation systems, airports, toll roads, utility grids, energy pipelines, telecommunications networks, hospitals, schools, and water treatment facilities. Infrastructure assets are attractive to institutional investors because they often generate stable and predictable cash flows over extended periods. Many infrastructure projects also possess monopolistic or quasi-monopolistic characteristics due to high barriers to entry and essential service demand. These investments can provide diversification benefits, inflation protection, and long-term income generation, making them suitable for pension funds, sovereign wealth funds, and insurance companies. The program distinguishes between economic infrastructure and social infrastructure investments. Economic infrastructure refers to assets that facilitate commerce and economic production, such as ports, railways, airports, utility systems, and energy distribution networks. These assets are often directly linked to economic growth and industrial activity. Social infrastructure includes assets that provide public welfare services, such as schools, hospitals, prisons, and public housing facilities. While economic infrastructure may depend heavily on usage levels and economic demand, social infrastructure projects are often supported by long-term government contracts or availability payments. Both categories generally involve substantial capital requirements, long asset lives, and complex operational management responsibilities that require specialized expertise from investment managers and operators. Infrastructure investments are frequently structured through public-private partnerships, PPPs, where government entities and private investors jointly finance, construct, and operate infrastructure assets. Governments may rely on private capital because infrastructure projects require large upfront expenditures and specialized operational capabilities. Under PPP arrangements, private investors may receive long-term concession rights, usage fees, or contractual payments in exchange for assuming construction and operational responsibilities. Some projects eventually revert to public ownership after a specified concession period. These arrangements allow governments to expand infrastructure development without bearing the full financial burden immediately. However, PPPs also involve political, regulatory, and contractual risks that can affect investment returns if regulations, usage assumptions, or public policies change unexpectedly. A major attraction of infrastructure investing is the potential for stable and inflation-linked cash flows. Many infrastructure assets provide essential services with relatively inelastic demand, meaning consumers continue using them even during economic downturns. Utility systems, transportation networks, and regulated monopolies may generate recurring revenues through user fees, tariffs, or long-term service contracts. In some cases, pricing agreements are directly linked to inflation indices, helping preserve the real value of investor returns over time. Because infrastructure assets often have predictable operating characteristics and long economic lives, they are particularly appealing to institutional investors seeking steady income streams that align with long-term liabilities such as pension obligations and insurance commitments. Despite their attractive characteristics, infrastructure investments involve several important risks. Political and regulatory risks are particularly significant because governments heavily influence infrastructure pricing, environmental standards, and operating permissions. Changes in regulation or public policy may negatively affect profitability or asset valuation. Construction risk is another concern, especially during early project stages when delays, cost overruns, labor disputes, or technical failures may occur. Infrastructure assets are also relatively illiquid, making them difficult to sell quickly without substantial transaction costs. Furthermore, revenues may decline if economic conditions weaken or projected usage levels fail to materialize. Investors must therefore conduct extensive due diligence regarding contracts, financing structures, operational expertise, and regulatory environments before committing capital. Overall, topic demonstrates that infrastructure investments represent a unique and increasingly important segment of alternative investments. These assets provide essential public services while offering investors opportunities for stable cash flows, diversification benefits, inflation protection, and long-term capital appreciation. Economic and social infrastructure projects can be accessed through direct ownership, private funds, or public-private partnerships depending on investor objectives and expertise. However, infrastructure investing also requires careful evaluation of political, regulatory, operational, and financing risks that may influence long-term performance. For CFA candidates, understanding infrastructure investment structures and characteristics is essential because institutional portfolios increasingly allocate capital toward infrastructure assets as part of broader diversification and income generation strategies.